You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate expert and founder and CEO of Broadwell Property Group, Tony Morgan. Now, Tony has more than 30 years of experience leading startup and high-growth companies in a number of different industries and verticals. Tony has a proven track record of taking a project from concept through reality, through operational challenges, and ending with a financially positive exit. And so, guys, with that, I'm excited to honor and welcome my guest for today's show, Tony Morgan. Tony, how you doing today, my friend?
I'm good, Kevin. How are you, sir? Thank you very much.
I'm doing great, my friend. Excited to have you here and excited to dig into your background a little bit. I know that you're not a lifetime real estate guy. You've been involved in many different types of businesses and in many different capacities. And so excited to kind of peel back the layers a little bit. And before we dive into the real estate talk, learn a little bit more about you and your background and your experience and kind of where you got your start. So maybe take a few minutes and tell us a little bit more about you, Tony.
Well, I'll tell you that you may not have ever had anybody on your podcast who's had as many failures as I've had.
I don't know about that. but I'll put you to the test.
But I embrace that. I like to say that I had 8 failed businesses before I ever had one that was successful. I knew I didn't want to work for somebody the rest of my life. I had that entrepreneurial gene. It was inside of me. There was nothing I could do for it. But after a while, man, that wears on you. And so, as the story goes, after number 8, I wondered if my dad, maybe he had it right. And I should just go to work for a big company and really do work hard and work my way up and get a pension and 401k and 2.5 kids and white picket fence, American dream, right? And so I went to work for a large company. I worked hard. I worked my way up in that company. And they saw in me what I saw in me. And so I got promoted a lot. And then before I was even 30 years old, they brought me into what they call their executive management training program. And it was an extensive training program. We spent a whole year. And during that whole year, Kevin, I learned all the little mistakes that I made along the way. So during that year, while they were teaching me how to operate their company, they were teaching me how to operate any company. Mm-hmm. And I got to tell you, companies don't matter. It doesn't. I'm in real estate now, but it's just another company. You treat it the same way. You operate it the same way. Eventually, they're going to be exactly the same. It's just what we're selling is different.
Yep.
So with that, I had an opportunity that came around to get into the internet when it was brand new. I was a little bit of a geek and knew some friends that were, and we decided to start our what's called a web hosting company that eventually turned into multi-tenant data centers. And so that's when I really got the real estate bug, is dealing in data centers. And started diversifying out of that as a limited partner, started investing in other people's apartment complexes. I've got them in Texas and the Carolinas and probably names I'm probably invested in some of their deals. And I still am. To this day, I'm still a very active LP. Mm-hmm. And but when the time came for me to sell, I got tired of competing with Amazon in the data center business. And so in 2018, I sold. And the idea was I was going to retire and let my LP work kind of just dwindle. And after a few months, I got tired of playing golf, and my wife was like, "You got to get out of the house." And so I ended up deciding to take the step over to the GP side. And so I decided I needed a team. I needed to partner up with some people who knew a lot more about that business than I did. So I was able to find some key people, put them in the right positions around us. We partnered up, and Broadwell Property Group was born. And from that, we've gotten into multifamily and some other things. We do some lending. We do quite a few things. But it's been an interesting run, but we're enjoying it. It's a fun ride.
Yeah, good deal. Well, I'd like to kind of dissect a little bit, going from LP, and multiple different investments to actually over on to the GP side. And any of the unknowns that might have come your way, right? Like you understood the business from a higher level, maybe not fully from an operational standpoint, but you still understood the business in its entirety. You just haven't it was all theoretical, right? It wasn't actually in practice yet until you actually stepped into the GP side. So what were some of the big unexpected factors once you actually stepped into the GP side of things?
The funniest lesson I learned was that real estate moves awfully slow compared to the internet. I had to get used to lawyers taking days to return a call. The joke that I made during my first deal is in the internet days, we could make a deal over lunch worth millions of dollars, and by dinner it was in place. That doesn't happen in this business, and that took a little getting used to for me. From a flip side, though, the truth is there's a lot more similarities and differences. It's just a product. And once you realize that you've got to take care of your customer, whatever that customer is, it might be, in our case, it might be tenants, it might be vendors, it might be, it could be investors, but you have a customer you need to take care of. You take care of that customer, you do your customer right, you'll eventually make your money. And that is a sound principle that I've brought into every business I've ever been in. We've always been known as the customer service company, no matter what we've ever done.
Mm-hmm. Good deal. So I want to talk about commercial real estate, right? Like you ultimately have LP investments in multifamily, which is just, one of the many different types of assets underneath the commercial real estate umbrella. However, when you determine or decided that you were going to form a Broadwell Property Group, you decided on the GP side that you guys were going to continue running at the multifamily sector. What really made you decide, both back as an LP when you were looking to place capital and with different sponsors, what have you, what really made you land on the multifamily space versus the many other sectors that are out there? I mean, you got senior living, you've got retail, you've got office, which wouldn't be an office right now. I don't think that's a great long-term play. We'll see how that goes. But hotels, which hospitality, which I surely wouldn't want to be in today. But ultimately, there was a lot of choices. But you landed on multifamily. Why?
I felt like multifamily was the closest thing to anything that was recession-proof. Having operated through two major recessions, operated companies, owned companies, had to deal with the pitfalls of a recession. I wanted to try to find something that was as recession-proof as I could find. Mm-hmm. And nothing. I'm not here to tell you that there's anything that's recession-proof. I firmly believe that nothing is quote unquote recession-proof, but I'm trying to look for the closest thing I can find. And I always felt like that multifamily had that opportunity to be as close to recession-proof as possible. And so that was probably the number one ingredient. Secondly, as an LP, I wanted to find sponsors that I could relate to and understand and felt like that our interests were aligned, that had experience, that had, the deals were in such a way that excited me. And so that was probably the two things that intrigued me the most about multifamily.
Okay. How about finding deals today in such a competitive landscape? We were talking about that a little bit before we started recording. It's just, it seems like every day I see at least a dozen new posts on Facebook about folks that are getting into the multifamily space or, getting into the mobile home park space. As I mentioned, is the business that we're in. Sure. And ultimately there's a, finite amount of supply. I mean, I know there's new supply coming in the market, multifamily. I guess in mobile home parks, you could say there's a finite amount of supply because it's actually got a diminishing amount of inventory out there as they redevelop these older parks. But in any event, I feel like there's more people coming in trying to compete for these opportunities than there are new products coming online. And so how have you been able to find opportunities in today's competitive landscape?
In the simplest answer to that question is we haven't.
Yeah,
we haven't.
Interesting.
We have been net sellers, not trying to be. Mm-hmm. We started Broadwell and immediately went out and bought. And then COVID happened and we kind of started watching what was going on. We already knew that the market the cycle, as we call it, was coming around. Everybody knew that, but we were prepared for a cycle, right? What we weren't prepared for was COVID. And so nobody was. But then you realize COVID really didn't affect us that bad. As a general rule, it really didn't. Our properties performed well. We didn't have any. Our property managers have been very good about keeping the properties in tip-top shape. The tenants have been paying. We've had, I will say towards the end of last year to begin this year, you started to see a little delinquency issue, but we all have. But our property managers have been very good about finding rental assistance, finding different organizations with churches and different groups that we have people that are getting their rent paid by other people, and we're perfectly happy with that. And so it's worked out okay for us. But with that said, what's happened is that the compression in the interest rates and the compression in the cap rates we don't find deals worth buying right now. So we're struggling. We're trying to find deals, and we're having a hard time finding ones that meet our criteria. We're so picky. We're just absolutely so picky that we'd rather do no deals than bad deals. And so we're ended up being net selling right now because we're getting offers for the properties we have that are unbelievable. And we owe it to ourselves and our investors to entertain those deals. And when we see what's happening today, it's I got a feeling we might be buying some of these same ones back one day.
Let's expand on that a little bit.
Sure.
And we're typically net buyers, but we have sold some assets over the past year, for a variety of reasons. And, and just like everyone else, we've had, similar challenges finding new, what I would call opportunities, deals that truly fit within the confines of our, buying criteria without stretching in any manner.
Agreed.
And it's been tough, and it's been really tough. And, just looking at some of the properties that we've sold, I know what we paid for them. I know how they operate. And I'm not saying we're the best operator. There's surely folks that have better systems and processes and can do what I do, but do it better. And I'm not ever going to be one to say that I'm the best in any manner, right? There's always a better way to do it, always a better way to skin that cat. But I struggle on a number of the sales to see how, that next buyer truly is going to find that upside or find that extra dollar. And it's going to be a very hard dollar to extract. And so, but then I question myself, right? Like I'm sure you guys probably have as well. It's like, what is that buyer seeing that I might not be seeing? Like what do they know that I don't know? And I do believe in some instances there are things that we might not see, right? You get blinded when you're in your own asset, when you're running it. Sometimes you don't lose focus, but you don't step out of that bubble often enough to look around. And so are there ways to drive the revenue, drive the NOI on that property that you might not be seeing that others have? And so I guess my question to you would be, what are all these other multifamily buyers? What are they seeing? And where are they finding the value that maybe Broadwell isn't finding or that's not seeing? I mean, what are they doing differently?
There's two answers to that question. There's the answer that I can say with all, understanding that it's the politically correct answer, which is that they, like, for example, I know one friend of mine, and he's done a really, really good job. He's hooked up with an internet provider, and they're going into these, they're not buying anything less than 300 or 400 units. And they're going into these places, they're bringing their own internet in, they're driving NOI increases literally just inside the internet. And by providing those services, because I have a technology background, he came to me for advice, and I gave him some really good advice that I think will help him. And it got us looking at what we might could do with those same things in our communities. And so there, I do believe that there are some ways to increase NOI in those respects. But even with that, for it to get to where it's at today still makes me scratch my head. Then it's the not so politically correct answer, which is maybe there's just so much money out there right now and investors are not as savvy that they are doing deals for the sake of doing deals. Mm-hmm. And I'll tell you that it is one of the things that keep in mind, I'm not putting it all in a basket, because there's a number of people who I trust and I still, to this day, I still invest with. So I'm not saying that I'm just saying there's a lot of people out there that are doing questionable deals. Mm-hmm. And I look at them because I'll pass on them. We'll bring them together. We'll talk about them. We have a whole system for underwriting here. And we use an online system where we can all share it. We all see it. We can make notes and comments and where we all think. And until we all agree, that's when we move forward. And so these same deals that we have decided we can't do, and to see other people do that maybe aren't as aggressive, aren't as sophisticated as even we are. I sometimes scratch my head. It makes you wonder what may be happening behind the scenes. And it's a little scary. And that's why we're trying to be conservative. We try to, one of the things, a joke that's happened a lot lately, and it's kind of hard for somebody when I talk to them and they go, man, we're just so conservative with COVID and with everything else. We're just so conservative. Well, how many deals have you done last year? I've done 12. Are you really being conservative if you've done 12 deals in the last year? You know what I'm saying? That doesn't compute to me, you know?
Yeah, no, I agree with you. Very interesting. So, I correct me if I'm wrong. I believe that you guys are mostly focused on the Metro Atlanta area. Is that correct, or do you expand beyond that?
On our LP side, we're expanded beyond that, but on the GP side, we are looking in other areas, but we there's always we will be more aggressive in our backyard. Yes.
Okay.
So we're actively being more aggressive in our criteria in our backyard.
What are you seeing as far as, like, if you get out of Metro Atlanta and go into some of the secondary and tertiary markets surrounding Metro Atlanta, are you finding that there's maybe some opportunity there, or no, or is that just as competitive?
It's getting just as competitive. We within the group here, we've got a couple of properties down in Middle Georgia, and to see the number of New York investors that are now going down there to buy because they've looked at Atlanta, they feel like Atlanta is overpriced, so now they're going into the secondary, tertiary markets, and they're using their New York or Los Angeles thought processes in buying in those areas. Like, well, that's cheap compared to home. Well, of course it is a different market. And so that seems to be driving up those prices as well. Now, are they as expensive as Atlanta? Of course not. No, they never will be. But they also don't have the potential of appreciation that you have in a metropolitan like Atlanta either. So cash flow becomes critical in those areas because you're not going to get the appreciation that you're going to get in, say, in Metro Atlanta.
Yeah, no, absolutely. I agree with that. And I'm going to switch gears real quick. And I know a lot of folks always talk about vetting sponsors, right? Speaking from the LP side, there's been many times we've had this topic and discussed it on the show, vetting sponsors, right? What to look for, track record, financial capabilities, lots of, anyway, I don't want to get on the side because that's not where we're going to go with this, but I'm going to flip it to the other side. Being a GP and vetting potential LPs, right? And so, what do you guys do? Do you guys do anything special as far as finding the right LPs for your deals? I found over the years that there's really good fits and then there's not so great fits, and
right.
and we're really keen to make sure that it's the right relationship, that ultimately that we're the right fit for that LP and the LP is the right fit for us, because ultimately it's a long-term marriage. And so, are there any things that you guys do special as to help find the right fits when seeking out capital and raising capital?
Right. I would like to answer the question you didn't ask as well as the question you asked. And when I say the question you didn't ask is people ask me all the time, how do I vet a sponsor? Yeah. And I say, oh, simple. I go to LinkedIn, I find out what they were doing for a living in 2008.
That's funny.
If they were working in a cubicle, I'm probably not going to invest with them. Yep. But to go back to your point, yes, we've been lucky in that we're not having to draw up investors like a lot of sponsors have to do. And we're blessed in that respect. I don't mean to make too much of it, but I'm lucky enough to be there's never been an investor in any of our deals larger than me. And so that helps. I'm asking investors to invest beside me, not in me. And so they know that, and a lot of them come from my background. They didn't come from a podcast or from, what we've done. They're people I've dealt with over the years, and a lot of them come from technology. And so it's a little bit easier when I have that relationship with them already. They don't really vet me that much because they understand the track record that I bring. And they also understand that I have more to lose than they do.
Gotcha.
And so that helps. We're lucky in that respect, and I know that's a big thing for most syndicators, and we're very blessed in that. And that's one of those things where it's I have to say I'm glad I don't have to deal with that problem as much as some people do.
Yeah, no, that's great. I appreciate that. And everyone always talks about all the great deals, the deals that made the most money, highest ROI. No one ever really focuses on the deals that went sideways, or they lost money, or had a bad partnership, or the litany of other things that could ultimately go wrong. And so when I go through that, what comes to mind? Everyone's got that one or potentially more deals that just never met expectations, never turned out exactly how they thought it would in the long run. And so, what deal comes to mind when I say that? And if you would, please share details, a little bit about the deal, what went wrong, and then ultimately, what you would have done the second time around to potentially avoid that same mistake?
Remember when we first started, and I said I had a lot more failures than I did successes.
Yeah.
So yes, it's we could spend 2 podcasts just going over my failures. I got plenty. We can choose from a lot of them. But the truth is that what's most important is what you learn from them, is what you gain from them. And I believe that in every failure comes a gain. And so it's I embrace the failures because it's what brought me to the point I am today, which is less and less of these failures, because as it goes back to what we said before, I'm not as aggressive. I'm trying to make sure that I am underwriting deals a lot differently, because it's because with experience comes that. As we said before, I've been in a lot of different businesses, a lot of different kinds of businesses, from technology to you name it. I've been in it, and I remember it was 2000, I think, and there was a large trade show in Las Vegas for the internet people called Comdex. It was huge. And so I was out there for Comdex, and I rode in my very first limo bus, and it was cool, man. It was so much fun. And I thought to myself, things are going great, and at that point, the failures that I'd had seemed like a lifetime ago, because everything had just been going so well on the internet for me. And so I got home completely convinced that Atlanta needed just that. They absolutely must have this really flashy limo bus company. And so I went out and wrote checks and bought big buses and converted them and did all that stuff. And, we struggled. We struggled. And after several years, my accounting team came to me like, Tony, you're throwing good money after bad. What are you doing here? This is crazy. Let's cut our losses and get out. This is not what we do. This is crazy. And so after several years, I realized that, they were right. And I needed to do that. And so we ended up shutting it down, lost a lot of money. And I've had people ask me, this same question before. And I always say, I need to find what went wrong and how can I make sure that doesn't happen again? And so people would say, well, of course, you don't want to keep throwing good money after bad. And I'm like, no, the mistakes were made way before that. Way before that. The mistakes were made in the underwriting. The mistakes were made in the fact that I let emotions get in the way of the deal. So it was such a cool idea to me. It was like it couldn't fail. Oh, yes, it can. And so when you start looking at that, and then you look at, most people, especially since we've been through 08, forget the 01. We had a pretty good sized recession as well. Remember, I told you this was Comdex of 2000. Mm-hmm. Right. So I had a year to invest all that money right into a recession. So do you think people were paying for extravagances in 01 and 02? No, they weren't. And so that was timing. It was saying that things are going so well right now. How can they go bad? Which makes me more nervous about today. Mm-hmm. It's exactly the type of thing that I feel today among a lot of people in this business. Oh, look at what we've been doing for the last 2 or 4 or 5, 8, 10 years. Oh my goodness. That doesn't necessarily mean it's going to be that way next year. And that's where, and I'm not saying, keep in mind, I'm still in the business and I still want to be in the business. I'm not saying the business is bad. Not at all. I'm not saying that. I am saying be careful, be smart, make sure that you have thought out your exit strategies, which is what I did not do very well with my limo company.
Gotcha. No, and I appreciate the vulnerability there and you sharing the details of that. And kind of takes me to my next question. I want this to be a real estate related one. And just, for context here, when did you found Broadwell Property Group? When did that happen?
Basically late 2018. And
okay.
We started doing LP investing before that. But
okay, gotcha. But I want to speak to the GP side, if we could. A deal over the last couple of years, 3 years since Broadwell was formed, a deal that you got into due diligence, looked good on the outside looking in, you underwrote it, you guys felt comfortable with going down that path and diving into the inspection period, but ultimately walked away from it. Something came up, something was discovered, whatever that might be, that ultimately you guys decided to kill the deal and move on. Was there any? Maybe there was none. Maybe that just didn't happen. But
we saw that during COVID
okay.
Because what ended up happening towards the end of last year is, and I think we can look back at it now and say, yeah, we're all in that same boat. But we were looking at deals last fall. And it was Bill, who is one of our partners here, who started really paying attention to the fact that, okay, the way most people run their T12s and accruals and rent rolls. So you look at your rent roll, you look at your T12, and it's all based on accruals, right? We all know that.
Mm-hmm.
But the problem with that is sometimes delinquencies don't show up there like they do on the rent roll, right? We all know to look for that today. We're months and months into that now. We understand that. But back then, we weren't as keyed on that column of the rent roll that said delinquency, right? How much are these people behind? And what he started finding was we were underwriting based on rent collections that we thought, because the rent had not been written off yet, it didn't hit the T12.
Mm-hmm.
It was being carried on the rent roll, right? So because it wasn't being written off, the only place you would find it is in the rent roll or an aging report. Now we all ask for aging reports. We've learned, we've gotten better. But were we all asking for aging reports last summer? See, that maybe the bank score is you got really into it, but most of us in the beginning, that wasn't one of the first things we were asking for. Give me the rent roll of T12. I can tell you that was, very cocky, but we all felt that way.
Mm-hmm.
Well, now you start realizing that there is more to that on that collection side. And so we started seeing collection. So I can remember specifically a deal that I was excited about buying. And we all were. I really thought that was going to be our big hit during COVID. And then when we realized that we had a collection issue that didn't show up in any of the other underwriting until we really dug into that part of it. And that started showing up in the T3, and that's where you start seeing those kind of deals. That's and again, we all know to look for it today. In last summer, it wasn't as prevalent.
How big of a collection issue was that? I mean, obviously it was big enough for you guys to kill the deal, but are we talking like 8% of the tenant base, 5%?
Well, what it was, and off the top of my head, Kevin, I don't remember the percentage, but what I will say is this: I remember that the issues were a percent, and I want to say it was around a 250 unit deal, and it was at least 10% of them were long term, meaning it was well more than 1 month behind. So these people had already decided they weren't going to pay until somebody forced them to. You already knew that. And we had no idea how long this moratorium was going to go on. And we still don't know how long it's going to go on. So those people, as far as I know, are probably still living in those units for free, waiting on the point that they're going to be eventually evicted. And they get that. It's and we know it when we're looking at buying now. We're looking at those people going, no, we know those are going to be evictions, and we know we can't count any income for those units until the end, unless we're going to do cash for keys, which we've done some of that. And now the question is, how much are you willing to invest in getting that tenant out?
Well, so that there's multiple factors there to consider. It's the lack of revenue or loss of revenue from those tenants not paying. It's a legal expense associated with getting them out. Or legal expense or the cash for keys expense, one of the two. And then outside of that, you've got the make ready costs, right? You've got additional downtime as the unit gets back online, which you're going to have, another, couple thousand, $3,000, $4,000, $5,000 there to get the unit back online, assuming that they didn't completely trash it on their way out after being mad at you for kicking them out after COVID. And so it becomes a very expensive endeavor. And so in fact, we're in the middle of a deal right now. I mean, we're literally in due diligence on the deal, and I knew it had a little bit of hair on it, and I knew that going in, and so I wasn't overly scared. But then we literally got the aged delinquent report, aged rent roll, and there's literally like another 10 folks, which makes it's not a huge community. It's a 100 space community. So
it's 10%.
It's significant that are 30 to 60 or 60 to 90. I mean, that are basically that haven't paid in more than a month, and a couple of those that are just getting now into active evictions. I'm like, well, basically all 10 of these, I'm just going to assume that they're going to be gone as well. And so while I thought there was a little bit of hair, this thing is bushy. This thing is incredibly hairy now.
Absolutely.
And there's a lot of expense associated with me getting all these people out of here, and the cost to renovate the unit, what have you. And so it changed a decent deal, which we weren't scared of, into something that's kind of like, you know what, unless we get a massive price discount. I mean, pretty significant, which ultimately will probably kill the deal. So
correct.
When this actually airs, that deal will probably be dead. And if not, that means that we've got a significant discount on it. So either way.
Correct. And all those deals work at the right cap rate, meaning if you're buying it at the right price, I can make all of them work. I don't care how bad the rent roll is. I don't care how bad the delinquency is, as long as I can balance that out with the cost of the asset.
Absolutely.
And that's the key. I'm not scared of it. I'm not going to pay to inherit somebody else's problems.
That's
I'm not going to pay a premium to inherit somebody else's problems.
Yeah, I agree with you. Well, Tony, lots of great information here today. Lots of golden nuggets already shared. But what I'd like to ask of you is before we wrap it up here, if you had just one final golden nugget of advice or wisdom that you could leave with our listeners that might inspire and motivate them as they progress in their very own real estate investing career, what would that one last golden nugget be?
I will say one mistake that I made early on that I did not make this time when I got into real estate, and I highly suggest that nobody else makes that mistake either. And that is when I started my internet company and it really started to get some feet under it. I had opportunities to partner with people. I had opportunities to take on venture capitalist money. I had opportunities to take on investors, and I passed on every one of them. I was 22 years in that business and made a lot of money, but only a fraction of what I might have made had I listened to some of those people who had some experience in some of the larger business and how to take it from, from a 7-figure company to a 10-figure, how to really, do some damage with it, And I didn't. I tried to do it all myself, and I ended up where I feel like I could have really been a competitor at Amazon, one where they knew my name just as much as I knew theirs, right?
Yeah.
And I let that go. I did not make that mistake in real estate, and I don't ever suggest anybody else does either. Find you a group, partner with them, understand that there's an experience factor there. Give them whatever you got to give them. Make it worth their while. Bring what you can bring to the table, but understand that everybody has benefits that they can bring to a deal, and marry those benefits together. And if you're the geeky guy who loves spreadsheets and loves, then find somebody who's a good operator, and put those two things together. Find a guy who's good fundraising and bring him in, and all of a sudden now you've got a team. And I can't stress that enough. You need a team in order to make it in this business.
Yep. No, I love every bit of it. Tony, I really appreciate you coming on. For those that want to learn more about you and your group and what you guys have going on, where's the best place to find you?
BroadwellPropertyGroup.com. You can email me anytime, Tony@GoBroadwell.com. We're always here, and we're always looking for deals. We're always looking for partners. So my email, I live on email. So usually I will see somebody's email within a few hours. That comes back to my old technology background. And unless I'm sleeping, I'll see it pretty quickly.
Yeah. Awesome. Well, Tony, really appreciate having here. It's been a lot of fun, and wishing you guys all the best. Okay.
Thank you, Kevin. Really appreciate you having me, sir.
All right, guys, that's all we have for this week's show. And so until we meet again next week, this is your host, Kevin Butt, wishing you huge success. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.